Good morning, everybody. We've got people still logging on, but want to welcome you to this quarter's edition of WealthPoint's WP90X, which is 90 minutes of extraordinary education. And we promise not to disappoint today. So for all of you planning geeks in the audience, yours truly being one of them. I'm excited to introduce our topic, which is mitigating income and estate taxes with the optimized CLAT structure. And then we also have a little bit of a wrinkle utilizing PPLI. First, let me introduce our esteemed guest, Mr. Jonathon Morrison. He's a senior partner at Frazer, Rainey, Goldberg, and Arnold. Jonathon began his career doing high-end estate and income tax planning in Northern California, and is a brilliant tax attorney with a focus and a specialty, a niche area in this optimized CLAT or OCLAT area. Also, we have my partner, Ben Rainey, who is the lead of our private placement services division, and then myself. Most of you know me, but my name is Ryan Barradas, and I'll be monitoring this morning's presentation. And we'll go on to the next slide and go through some housekeeping items. So in terms of our learning objectives, we're going to go through an overview of the optimized CLAT structure and where it's applicable, understand the tax advantages of the OCLAT, and then how we can pair the OCLAT with life insurance, specifically private placement life insurance, to make it even more compelling. So essentially to supercharge this as again, income and estate tax and wealth management tool. So we're going to go through initially the traditional CLAT overview. What is an OCLAT, and as specifically because it differs from a traditional CLAT structure. Go through a case study so you can see a live case study and how it actually works, and the net effect to the family group, the charity, and the effect on mitigating income and estate taxes. Talk about OCLAT with private placement life insurance, which is something that we've been exploring for the last couple of years and have become more and more comfortable, specifically because of the perceived issues under 170F10. And Jonathon will be educating us on that as we go along. In terms of some reminders, Q&A, please type your questions into the Q&A feature at the bottom of your screen. I will be monitoring those questions. Do not use the chat function. So if you have a question, please use the Q&A button, and then I will interject with the presenters on a regular basis just to make sure that your questions are answered. If there are questions that are similar in nature, I may combine them. If you have a follow-up question, please don't hesitate to ask. We will have polling questions in order to comply with our CE requirements and make sure that there's proof that you have attended. We will do 3 polling questions throughout the presentation to make sure that we qualify for CPE credit. In each question, we're going to allow 2 minutes to receive your answer. There are no right and wrong. There is a right and wrong answer, but it's not a test. And if you're interested in receiving CE or CPE credit for attending the webinar, please look for and complete the survey. That is another requirement, that we need to have you complete the survey that's sent to you. And then the CE or CPE credits will be emailed to you by Kristen Teff in our office within 30 days of the webinar and completion of the survey. And if you have any questions at all, please don't hesitate to reach out to Kristen. Kristen Teff, who's our Director of Communications, at kristen@wealthpoint.net. And everybody will be receiving both a recording that you can share with other colleagues, and also a copy of the materials that will be presented and discussed today. So without further ado, I will turn it over to our esteemed guest, and it pains me to say that, but I actually like the guy. But Jonathon Morrison from Frazer, Ryan, and Arnold.
Very good. Thank you. So yeah, so today we're talking about a variant of a charitable trust. Most of you have probably heard of charitable lead trust. Sometimes I used to give these presentations and I'd say charitable lead trust, and people say, you mean a charitable remainder trust? Because that's what most people think is the only type of charitable trust out there. Turns out that charitable lead trust, especially if it's optimized, as you'll see here, can produce probably the most significant all-in tax and economic benefits of any charitable trust, IRS-approved charitable trust variant out there, especially if you layer on PPLI life insurance, which we'll talk about, subject to some risks, which we're going to get into in detail. But just to back up before we get into this, charitable lead trust are something, generally speaking, when they're set up in a very low interest rate environment, that's ideal. And so, charitable trusts were put in the tax code back in 1969, both the CRT and the lead trust. We never really had attractive interest rates until, about 15 years ago, 20 years ago. And so you saw a lot of CRTs for those, 30, 40 years there. And I think you're still seeing a lot of, especially kind of older tax professionals that go directly to the CRT. The IRS reports the same thing. They have not seen an uptick in lead trusts in the last 20 years. Even though we've had low interest rates, the number of lead trust is only about 5% of the charitable trust returns that are filed. So lots of CRTs out there. The lead trust is always sort of viewed as a sort of arcane, complicated, kind of weirder charitable trust, unless you're, really, really practicing the high end. And it's got a place for that. I mean, the wealthy, super wealthy families, lead trusts work really well, especially as an estate, federal estate tax solve. It's one of the only vehicles that you could gift an unlimited amount to during life or at death and immediately remove those assets from your taxable estate. So you see a lot of like deathbed type planning, older clients that haven't hundreds of millions of dollars and haven't done any planning. Lead trusts work really well for federal estate tax planning. And so Jackie Onassis famously, is associated with the lead trust. Where I just did an article in Forbes, sort of an expose on that topic. But about 10 years ago, I was running some numbers. I have a finance accounting background, and I realized, oh my goodness, a lead trust, if it's stretched and pulled, I call optimized, stretched and pulled as much as the IRS will allow us to do without going over the edge, without going shark fin, which has some risks. So just going as far as the IRS has approved, and then essentially repurposing it almost as a synthetic retirement strategy. I have a lot of clients that will fund this every year with up to 30% of their annual income. So a CLAT, in a lot of ways, at least the optimized CLAT, which we'll get into, looks a lot like a 401k in that you put money into it, you get a deduction, you can't touch the money for a while, and there's a bunch of money at the end that comes back to the family. The problem with your 401k is you can only put 20 grand into it. Profit sharing plan, a little bit more. But, I've done about, I think the last count was about 180 180 or so OCLATs over the last 10 years. And so these are mainly for high earners, athletes, actresses, executives, attorneys, investment professionals making a couple million a year, or just large transaction. And so again, you can put 30% of your income into this strategy. So that's kind of what and that's my article in the Estate Planning Journal back in September 2020. I published this on the cover of the journal, and it was really stretching the OCLAT and then repurposing it as a retirement account. So we'll talk more about that, but let's start with how does a CLAT work? If you're not familiar with just a plain old vanilla lead trust, the idea is the creator, the grantor, the donor puts money or stocks or bonds, puts assets into the name of a charitable lead trust. The charitable lead trust is going to pay some amount annually to charity or donor advised fund, private foundation. So it's making a stream of annuity payments. And those annuity payments might be even and equal, or you can change it. So maybe it's lower payments in the early years, or a little more in the back end, which we'll talk to about more. But once you put those assets in, you promise these stream of payments to charity. Those are irrevocable. That stream of payments to charity is irrevocable. And because it's irrevocable, the tax code gives the donor, the creator of the CLAT, an income tax deduction, assuming it's structured as a grantor trust. We're only talking about grantor trust, lead trusts, charitable lead trusts, grantor CLATs. The tax code gives the grantor income tax deduction equal to the present value of all of those payments. So, hey, I'm promising $100 to charity for the next 10 years for a total of $1,000. Well, because it's spread out over time, I don't get a full $1,000 deduction. I've got to take a discount rate. So maybe you get, an $800 deduction. So, and it's based on interest rates. The lower the interest rates, the higher your deduction. So if it's really high interest rates and you keep promising $1,000 to charity, you might only get a $600 deduction. If interest rates are low, like they were back in 2020, you might get a $900 deduction. At the end of the 10-year term, in our example, after charity's got its promised payments, whatever's left in the account, in a plain vanilla CLAT just comes right back to the donor. So it's a great way for donors to get a deduction now based on a promised irrevocable pledge to charity over a term of years, and then they get their money back. So that's a very simple, plain vanilla CLAT. A CLAT is like saying ice cream. There's lots of different flavors of ice cream. So this is like a vanilla one. And so there you see on this, there's a narrative form of what we just talked about right there. Okay, so that's cool, but that has limitations. Okay, and so an optimized CLAT stretches that concept in a bunch of different ways, which you see here. If you practice in this area, this is a grantor style CLAT, zeroed out. We'll talk about what that means. With a long term, typically 20, 30, or 40 years. The IRS has approved 118 years. There's no limit. Usually we see about 30 years. And then we've used not a true shark fin, meaning a dollar with a big balloon in year 30. The IRS has not yet approved that. I think most people think if you read the regulations, you could just do $1 every year and then spike it in the final year. But one of the head folks at the IRS in Washington, D.C. personally told me, hey, I know you do CLATs. I would stick to what we've approved. That was kind of how they left it. I don't know if they're waiting on a test case or something. But the regulations appear to allow shark fin. We stay away from it. Again, it's probably okay, but based on that comment, I didn't really want to recommend clients in a shark fin. So what we do is it's sort of like a softened shark fin. The IRS, like a GRAT, has approved starting with small payments and then increasing it by 20% every year. And so if you do that, you still get about 70% of all the charitable payments are backloaded to the final 5 years. So why would you do that? Well, if you think about it, you're getting income tax deduction today, and the longer you can push off those charitable payments, the more time you have to grow and invest the CLAT assets, which ultimately are coming back to the family. And so when you run the numbers, especially during low interest rate environment like we have here, you're essentially borrowing from charity at about a 4.5% rate based on the current September rate. And so the longer you can push off it's essentially a note payable to charity at 4.5%, you're going to leverage an arbitrage. This is an interest rate play. And so we're going to see how compelling those numbers can be. But in any event, here you see on this slide, this is a great slide. You see, number one, it's a grantor trust that allows us to get an upfront income tax deduction. And not only I mentioned before, if we put in this type of vehicle, it's called so-called zeroed out, meaning just like a GRAT. If I put $1 million into a GRAT, I get $1 million gift tax deduction. That's why you can put an unlimited amount of GRAT assets into a zeroed out GRAT, and there's no gift tax. Well, here you not only get an unlimited gift tax deduction, but you also get a dollar for dollar income tax deduction, federal and in most states also a state income tax deduction, including California and New York, where I do a lot of these. So if you put $1 million into the OCLAT, you get $1 million income tax deduction. Okay. The assets, number three, are also immediately removed from the 40% estate tax. We had a client pass away about 2 months after funding a CLAT, and those assets did not have to be reported on the federal estate tax return, the 706. And it does not use, just like a GRAT, it doesn't use any of your gift or estate tax exemption. What's the problem with a GRAT, though? A GRAT looks a lot like a CLAT, right? You can put money in it, you get an annuity payment, and then there's whatever comes back at the very end can be transferred to children or children's trusts without gift or estate tax. With a GRAT, we can only do these dinky 2 or 3 year GRATs, right? Because you die in the term, it all forfeits. It's all included in the estate. With this type of optimized CLAT, the client can die in the middle of the term, and then there's no estate tax inclusion. This is why the CLAT works so well, because we can go out 30 years and lock in today's interest rates, kick charity way off there, and there's no estate tax risk. There's no mortality risk because with an optimized CLAT, it's not included in the estate if the client dies. So that's part of when I get kind of show you how this looks like a traditional retirement, synthetic retirement account. It's how we're able to really lock in these lower rates because we don't have to worry about the client dying, unlike a GRAT. So number 3 and 4, no gift, no estate tax. It's also, the money is exempt from creditors' lawsuits. If it's single when you fund it, it's exempt from divorce. So the donor no longer owns these assets from creditor lawsuit, gift, and estate tax perspective. And then again, at the bottom there, we use typically 20 to 40 years, and we're deferring those charitable payments as much as the tax code allows. So this is all in the first section of my September 2020 Estate Planning Journal article, how we optimized it. And it's nothing new for those in the real high-end estate planning arena. This isn't a new concept. It's just the novel use of this CLAT really as a retirement account and really repurposing it for that purpose, and then just the whole process and everything that I've got together. But the actual chassis, the underlying terms of this CLAT is nothing really novel. We've also got a trust protector because it's a 30-year play. We've got a trust protector that can alter where the remainder goes to charity, to children, grandchildren, maybe even back to the donor, a so-called SPAT power. So we've got optionality to alter the charity, alter where the remainder goes. I think that's critically important given the long-term nature of this OCLAT. Okay, let's see.
Real quick question that came up. Other than the fact that it's not IRS approved, what are the main risks that you see with a shark fin CLAT?
I mean, I think most people read the regulations. It works because it basically says the regulations say there's no minimum or maximum annuity payment or term, and so if you read it that way, well, okay, I can have $1 every year and then balloon it at the end. I think the economics aren't that much more compelling if you're doing a 30-year 20% step like we do. If you compare that to a shark fin, it's not that much more compelling. But yeah, the risk is that if somehow the IRS comes back and says, hey, it's not a so-called quote guaranteed annuity because you were a little too cute with the payment structure. If you ask me, I think a shark fin works. But, if you go and research it, there's articles about why maybe it doesn't. And then that comment from one of the heads at the IRS, I didn't like that. So, for the right client that wants to take the risk, we disclose it and you can do a shark fin. That's perfectly fine.
So we're going to go ahead and do polling question number one. Go ahead and answer that question. And we're going to continue to move on, and it's going to be live, the polling question, for the next 2 minutes, 2 to 3 minutes. So go ahead.
Okay. I can go ahead now. Is that right? Okay. Let's see. Okay. So yeah, so here we are, just a very typical fact pattern. Okay. Again, after doing so many of these over the years, I'd say about half of my OCLATs are just regular high earners. They're, a surgeon making 3 million every year, or a baseball player making 10 million a year, reoccurring income. And their CPA says, sorry, you're a W-2, you're a 1099. There's nothing you can do. And then, there's all these crazy tax shelters out there and stuff that come and go, like conservation easements and such. But most, there's really not much you can do for a W-2 person. And so here's a solution. We can create this. I can do these. I promise these 48-hour expedited. At the end of the year, I do maybe 30 of these, and I get them all, one phone call, 48 hours, we get the account open, and just another account on with your investment manager. You control the investments, but we can put up to 30% of your income in there before December 31st and wipe out up to, 30% of your taxable income. So the other half are for spike years. I just had a lottery winner. The family won over $1 billion of lottery winnings. So we're doing a bunch of CLATs there. Sale of a company, executive, and I practiced in Silicon Valley for a decade. So a lot of executives with non-qualified options. When you exercise those, that's ordinary income, earned income. So, ordinary income is obviously the worst kind of income. The good news is about the OCLAT is that deduction, the way the tax return works out, that the income tax deduction you get with the CLAT, it eliminates ordinary income first before long-term capital gain. So if my client sells their company for 100 million and they've got $3 million of wages and bonus income that year, you better believe we're at least going to do a $3 million CLAT. And what we'll also usually do is go take all those IRAs, convert those to Roth to manufacture more ordinary income and wipe it all out with an OCLAT. So anytime you got a big long-term capital gain, you want to go and wipe out ordinary income and convert everything to Roth. It's kind of a typical design. But here we've got a 60-year-old single person, I think a single male, just sold their company for $50 million. What's great about the OCLAT, I'm kind of just peppering things in here, but this is one of the pretty much the only economic strategy, economically viable strategy that you can fund after a sale. So that's why I get very busy at the end of the year. I get all these calls around the country. Hey, I sold my company for 100 million. I didn't do any planning. Don't worry about it. We can put money in, just take the cash and put it into this CLAT. Your other options there are donor advised funds, private foundation, but those monies are permanently gone, right? Once you put money in a DAF or a PF, you never get anything back out of it. The CLAT gives you the same dollar for dollar deduction, $1 million into a DAF, $1 million into an OCLAT, same deduction, same $1 million deduction. But the OCLAT has this big kicker in 20, 30 years. It's going to come back to the family. So here you've got somebody that sold their company earlier this year for $50 million. They want to wipe out some of the income taxes. They want to do some wealth transfer planning to their children. And he's willing to set aside, lock up some of his net worth. He's got plenty of liquidity. So he's willing to lock up some of this money in the CLAT. The CLAT I call it a lockup period because during that charitable annuity period, you can invest the funds in mostly anything. And you can be pretty aggressive with those investments, subject to some gross negligence safeguards called the Jeopardy investment rules. But it's a lockup period because during that charitable period, the tax code says, hey, we'll give you a deduction up front, but you better not be touching that money. You can't borrow from it. Your family can't borrow from it. You can't take distributions. You can't buy homes. It's like a self-directed IRA. You better play by the rules. But once the charity's been paid off in full, after the end of 30 years, or you could accelerate it, and IRS says you can pay it all off early if you want. Once charity gets its final dollar, restrictive wrapper peels off, and the money's back to the family and is usable by the family. So you've got to have, somebody that's got significant savings set aside, because again, it's like a 401k. You don't want to overfund your 401k. You can't touch it for a while. So at this point, what we're going to do is I'm going to shift gears. I'm going to share my screen. I've got some material. I'm going to show you some material.
Real quick, we have
Yeah,
a question, Jonathan.
Yeah, sure.
It's can you please explain how you get a dollar for dollar deduction? Is it still limited to the AGI phase outs?
Yeah, so it's not a credit, it's a deduction, first off. So you don't put $1 million in there and it wipes out $1 million of tax. So $1 million deduction, if you're in California, they got 50% top rate, you're going to save $500,000 next April. And so if I put $1 million into an OCLAT, I get $1 million deduction. I'm going to give more than $1 million to charity. But if you take the present value of all those payments, it's exactly $1 million on a present value basis. I'm going to show you that on these materials. So let me go ahead and share my screen. We're going to go from kind of the simplest graphic to the more complex. Okay. All right. I just learned Control L from Ryan. Okay, let's see. Can you see my screen here?
Yes.
Okay, good. So my marketing guy developed this a couple of years ago. I really like this. We have a lot of clients that don't pay attention to the details. It's late in the year. And so they say, this kind of has everything on one page. We're going to go into more detail, but we've got everything from this to the journal, the white paper. But this is, just starting here, this is, again, everything is firmly supported by the tax code. We don't do shark fin. Everything's firmly supported, as you can read in the estate planning journal article. It's also been in Forbes and Fortune and Barron's and all sorts of stuff. Never had a known IRS audit. I've never been audited in my career after 500 transactions, about 180 of these being OCLATs. This is very unique. In everything that I do, I don't have any junior lawyers. Nobody touches any of this except for me. Every document, every memo, every annual review, everything I handle. I take a limited number of cases, charge a premium fee, but I don't rely on junior lawyers. Okay. Most large law firms, you talk to the senior guy. When I was in Silicon Valley, I was a third-year lawyer working on one of the 5th wealthiest people in the world. I didn't know what I was doing. I think it's a crazy model. This is too complex. Very hard to find junior lawyers, especially outside of Manhattan or Silicon Valley or Chicago. And so I elect to do everything, just take a limited number of cases. Raised about $500 million over the next 30 years, irrevocably committed. All this is peer reviewed. Again, in the journal article, took about 12 lawyers over 6 months. Everything checked out. Charge a one-time upfront tax deductible setup fee, 48-hour turnaround. So this is all. You can also, these links actually are active. I didn't know you could do this until recently. This is pretty cool. You can click on these and it'll take you to the. So I think we'll circulate this stuff, Ryan, all these materials. I can send them to you.
We will. Yes.
But here's the transaction, simple terms. Transfer $1 million into a new investment account in the name of this OCLAT. Put $1 million in, I get $1 million tax deduction. Depending on my tax bracket, I'm going to save somewhere probably between about 300 to 500 long-term capital gains to ordinary income in California. Based on the current rates, we're going to show you the calculator. On a 30-year, $1 million, you're going to have to pay about $3 million. You got to donate about $3 million over the 30-year term. Now, again, most of that comes out in the final 5 years. It's about 25 years to invest this before you got to break this off to your typical. It's a donor. We give this a donor advised fund. It's a charitable donor advised fund. From there, once it's in the DAF, you can reinvest it or give it away to any charity you want. And then at the end of the 30 years, depending on how well you invested the CLAT, there's going to be a bunch of money in that account. After giving the $3 million, you can project somewhere between probably $5 to $10 million. That money, those assets simply get transferred in kind, either back to the donor. Again, it's in kind. It's not like a 401k. 401k, you get with a bunch of ordinary income at the end when you withdraw it. And if you give a 401k to your kids, not only pay ordinary income tax, they also pay federal estate tax for a combined tax of up to about 70%. So here you got OCLAT assets come out without income tax or gift or inheritance taxes. So you get a deduction when you fund it, $1 million. All this money comes out without tax, got carryover basis, without tax, in-kind transfer to your kids' trust. During the 30-year period, we're going to talk about this is a grantor trust, so there is income taxes, and that's why we have the PPLI for that solve. But let's hold that for a minute. So this is rough economics, okay? Now let's go. Let me show you a couple more things. All right, I've got the okay. So let me just show briefly. We're not going to go through all this stuff, but here's a one-pager. This was my first. I developed this maybe 8 years ago. It's on one page. How's this work? Here's your income tax deduction, credit protection, exempt from estate and gift tax. Got the charitable lockup period, and here's 20 and 30-year example. So very, very simple on one page. Not as good looking as that infographic. What I hear after about 130 CLATs, here's my favorite document. 8 pages. I do high-end estate planning. This is just a little sliver. OCLATs are a little sliver of what I do. But everything that I have, I try to productize. So I try to have an infographic, an overview, and a frequently asked questions, and a financial model. I run financial projections. I do everything, give it away for free. Everything you're saying, I do these Zooms, I do the financial modeling. I do the same thing for what I call my optimized gift trust, which is kind of, big gifts, estate tax minimization. Run all the financial projections. I give it all away for free. And I like these FAQs. What's great is this allows clients or prospects, people that don't know about the CLAT or considering it, it allows them to front load all the information before they pay a single dollar of legal fees or accounting fees. They know what they're getting themselves into. So I encourage people, even before the first Zoom, take a look at the infographic, read these frequently asked questions. So this is, this goes through sort of the basics. Is this IRS approved? Yeah. You can read, I think it's in Fortune. I actually got to sit down with IRS commissioner under Obama. I read online that back in '98, he did an optimized CLAT. It was basically an optimized CLAT for Duke. It's got his name on the side of I think it's the basketball stadium. Anyways, we sat down with him and we have a whole article about that. I think it's in Fortune. But yeah, he did one of these, saw it through the 20-year term. And we got great quotes from him saying, this is the best investment vehicle ever. I do it all over again. He's got a finance background. He runs a finance firm. But yeah, IRS approval. Tell me about the upfront deduction. Tell me about the charitable lockup period. What happens if things go wrong? What happens if I die? What happens if I run out of money inside the CLAT? What about the money that comes back at the end? Tell me about that. Tax filings, logistical. So yeah, so this is very client friendly. So this is a great 20-minute read for somebody that's considering OCLAT. And then briefly, here's the estate planning journal article. Again, you can go read it.
And we will be sharing, somebody has asked if we will be sharing all of the materials that are being provided. So if we can move back into the presentation and, or if you wanted to show modeling.
I want to show the modeling now. Okay. So this is the calculator. Again, I developed, this is when I first was kind of coming up with the idea. I put this together. And this model actually comes pretty close to the modeling stochastic Monte Carlo models. So this kind of brings it to life. So here's the inputs. Well, how much you put into the CLAT? Let's just say 10 million. What's your tax bracket? Here in Arizona, we're at about 40% ordinary. And here's your rate of return. And then here's the benchmarking. This is this rate for September next month. You get to use this rate. The tax code's nice. They let you look back 3 months to the best rate. So we know even if interest rates jump to the moon over the next couple of months, as long as you fund your CLAT by the end of November, you lock in this 4.8. And we're waiting. We set up the account. A lot of my clients are waiting to see if interest rates drop, but we know worst case scenario, we got this benchmark. And so if you put $10 million in a 30-year CLAT, remember 3 times that amount right now, so 30 million to charity, 5x, 50 million at 8% return, you're gonna have about 5x, 50 million coming back. So that's the 1-3-5 rule that we saw in our infographic, right? 1-3-5. Now, what happens if, here's the benchmark. That's what we got to beat. So if you only get 4.8%, there's 0 left at the end. Okay. So this is interest rate arbitrage. Again, if we can get about 3 plus the benchmark, is about 5x coming back. Now, we're going to go look under the hood and then we'll come back. This is when you use the model, this is really all you use. Let me show you what's going on a 30-year CLAT. So here's our $10 million. Just another investment account, one new investment account you open up with your financial advisor. And we're assuming 8% every year. That's a flat level model. Again, we run the stochastic Monte Carlo variable return models. As long as you're going 20 or more years on your CLAT, this flat level return model and the stochastic model comes out pretty close. Why is that? Well, remember, we're pushing all those charitable payments toward the end. Charitable payments are very small in the beginning years. So you've got a lot of time to make up for bad markets. You hit a recession, first 10 years, it's okay. You got barely anything coming out. There's hardly any drain coming out to the DAF. Whereas with a 15-year, you got huge amounts coming out. So if you got recession, you might not be able to make up time. On a 30-year, payments are so small, you got plenty of time to make up. So here's the charitable payments. Again, they're backloaded as much as the IRS has approved. Okay. Most of those payments come out in the final 5 to 7 years. Total of 30 million to the charity, your donor advised fund, 50 million back. No estate tax, net to heirs, 50 million out of the CLAT. Now, we're not showing the annual income taxes, capital gains, income tax, all that. We're going to talk more about that when we get to the PPLI. We've run the model with as income tax affected, and it still comes out the same. You still have about 3 times as much wealth, CLAT versus no CLAT. Let's talk about the no CLAT. No CLAT is, hey, okay, Jonathan, this is great, but what if I don't do it? How much would I have? All right. You have $10 million of income. You pay $4 million of tax on that income, leaving you with $6 million. You put that in an account. You invest it at 8% rate of return. And for now, let's assume you're going to give to charity the same schedule, apples to apples. You're going to give to charity regardless. Okay. What you see is you only have $30 million given to charity. Again, apples to apples. You give to charity on the same schedule with income tax deductions every year. You only have $30 million versus 50. So you get an extra $20 million of delta, economic delta. And then you pay estate taxes on that money. So 40%, you die there. Net to heirs, you got about 3 times as much with the CLAT. Now, I'm going to alter some of those assumptions, but I call this the 3X phenomenon. If you have a client that knows they're going to give to charity anyways, they come out about 3 times ahead. Okay. So let me show you this. I'm going to go change a couple things. So I think we got that. That's pretty simple. This all comes back here. Here's what you would have without the CLAT. Here's with the CLAT. So you get an extra $20 million economic, plus the estate tax savings that you don't have to pay. So here's the all-in benefit to the family. You got about 3 times as much wealth. Now, let me tweak a couple things. Let's say, all right, well, Jonathan, that's not realistic. I'm not really going to give the same schedule of charitable payments over the next 30 years. Okay, what do you give them per year? I don't know. We give about, I don't know, maybe, we're planning on giving, well, we just sold the company, so we're planning on giving, yeah, probably $150,000 a year. Okay, let's go see how much you'd have. So let's go back to our 30-year. Take the same $10 million, pay taxes on it, put it in an account, set it aside for charity. Invest at 8%, give 150 grand per year to your favorite charities. Take those deductions every year. This model accounts for it. And what you see is you only have, well, that doesn't work. Let's see. Yeah, you got $50 million. So this chart's doing something funky over here. You'd have the same amount, 50 million economic, but you only gave $4.5 million to charity. With the CLAT, you gave an extra $25 million to charity. And you had to pay $20 million of estate tax on that money. So you get charity wins, the family wins on the estate tax savings. So you got about, almost twice as much wealth. And so what we usually do is it's say, okay, well, maybe we back into, put a full $10 million. What if we just put, I don't know, 5 in? And you see, now you got more economic. It's doing wonky stuff. You got an extra $6 million at term and the state tax savings. So usually what I tell clients is, how much are you giving to charity? Let's back in and see how much should we put into the CLAT. But you're going to win. If you got a charitable client, you're always going to win with the CLAT. The reason is they get the upfront deduction now in their big year. They sold their company. You don't have to wait for all those deductions. And all of this growth is occurring in a federal estate tax-free wrapper. So it all comes back here. Yeah, sure. Go ahead.
Really quick, a couple of questions. The first question was, and I answered it in the background, but is the income tax deduction in year one? And the answer to that is yes, you get the deduction in the first year. And the second question is the situs of the OCLATs that you create always in Arizona?
Yeah, situs doesn't really matter. I apply them for Arizona because I'm not licensed in every state, and I've done these in most states. Situs doesn't really matter. Usually what we'll do is we'll set the CLAT up. We're in a rush at the end of the year, and then we'll go reach out to local counsel the next year, have them review it. And if we need to surgically amend, I've got mechanisms in the CLAT document where we can surgically amend. And there's some state, state trust law thing that's bugging the local attorney. But yeah, this is a federal income tax deduction, state income tax deduction. It doesn't have any bearing on what the governing law really doesn't matter when it comes to the CLAT. So,
Next question, if that money is invested, money deposited into the CLAT, and I answered this behind the scenes, but if the money's deposited in the CLAT and it's invested in real estate, would the grantor get the tax benefits of depreciation and what have you from the real estate, just like any other grantor trust?
Yeah, that's right. So this is a total pass-through, okay? Think about it as like a disregarded entity. It's a grantor trust. So that just means a disregarded entity. So all the income and gains and all the losses and depreciation deductions on that real estate, all that accelerated depreciation, that cost seg on that new investment property in the CLAT, all of that comes through, yes, to the 1040. So you could take this $10 million, get a $10 million deduction, invest this immediately into $10 million of real estate, cost seg, take a big old, $8 million deduction for a total deduction of maybe $18 million.
And then is this subject to the 30% AGI limitation for charitable deduction is another?
Yep. Yeah, that's, let me stop screen so I can see it for a minute. Yes. So CLATs are subject to the 30% AGI limit. Whether you put cash in there or stocks and bonds or investment real estate, the deduction is up to your 30% of AGI with a 5-year carry forward. So that means if you have a $10 million income and you put $5 million in the optimized CLAT, you only get to take $3 million of deduction this year, 30% of 10. You got an excess $2 million that you didn't use. That deduction is rolled forward for up to 5 years. The only exception to the 30% rule is that if your CLAT can feed a private foundation, the haircut is the AGI is only 20% limit. So usually we're funding a donor advised fund out of the CLAT. Because not only is the AGI limit higher, but if the CLAT feeds a private foundation and the grantor is on that board of the private foundation, that can cause the CLAT to be subject to estate taxes. The IRS says, wait, you're feeding a private foundation and you're on the board there? Too much control. So you avoid that with the donor advised fund being the receptacle of the CLAT.
Got it.
Let me go back. We've got a lot of time. We got another 45 minutes. So let me show you a couple more things on that Excel model, and then I want to get to the PPLI discussion. Okay. Ryan, can you see the screen?
Yep.
Okay. So let me show, there's always some common questions. Okay, the first is, okay, well, what if I can get, 10% return? That's where you saw it's about 12x. That's remember our infographic right here. You can see the 12 million. Most of my clients, see this as, hey, I got 30 years. I'm not touching this money. I'm going to put this in private equity, at least for the first, 10, 20 years. And they're getting 10, 12% rates of return. This is not uncommon. We like to show 8%. It's pretty much a stock heavy equities portfolio. But there's no limit. The first 30 million on a $10 million CLAT, the first 30 has to go to charity. But that's fixed. That never changes. And again, that's based on this benchmark rate. That's fixed for the full 30-year term. It's all we got to beat. All the upside comes back to the family. Okay. So one common question is, okay, what happens if this thing fails? Let's say, I fund this, and I put it in a couple concentrated positions. These CLATs are subject to some of the rules that are applicable to private foundations. One of those is jeopardy investments prohibition. What's that mean? It means you can't be grossly negligent. You can't do really dumb stuff with can't put it all in Bitcoin. You can't put it all and buy some naked put option. But you can have, a bucket of 4 or 5 concentrated positions. The IRS says that's okay. So, but let's say you put it in, and let's go back to our 30-year. Let's say you get here and there's 0. There's nothing left in the CLAT. You say, oh, this went down to 0. And you call me up and you say, Jonathan, oh my goodness, I owe another $30 million to charity and I got nothing left in the CLAT. Am I in trouble? I say, well, what'd you invest in? Oh, I was diversified. I had like 4 or 5 different stocks. They just all went to 0. And I say, well, you're okay. This went to 0. The only bad news is you're not getting anything back out of it at year 30. There's nothing left for your family. But number one, there is no personal liability to make up all these remaining payments to charity. Again, as long as you weren't really done with the money, there's no charity that can sue the CLAT. Charity just does not get the full amount it was promised. Okay. Number 2, you still got that $10 million deduction. Now, that's not taken away. It's not taken away from you. Okay. And number 3, remember how this is a pass-through? All those losses, when you wrote it down to 0, those all showed up on your personal 1040. So you got a $10 million deduction. You got $10 million in losses on your 1040 and no personal liability to pay charity. Okay. There's some theoretical argument that if you die within the next, until you're 30, there could be some recapture of some of that income tax deduction. But still, you won on the income tax deduction. You won on the losses down to 0. You didn't have to pay charity all that money. You die in the next 30 years, there might be some adverse income tax deductions, consequences. And a lot of my clients, will hedge if they get into trouble like that, or they put a huge amount into this CLAT, they'll get some term life insurance on the side just to hedge against recapture. And we're going to talk about that. That's death within the 30-year term. Let's talk about that right now. So just to finish that thought, so if it goes down to 0, a lot of my clients say, wait a second, worst case scenario, it's almost just like I gave all the money away to charity up front. I got that deduction. So a lot of my clients, like I have a lot of professional stock traders that are getting crazy returns. They love this. They got a lot of short-term capital gains, ordinary income, because they're trading. So they like this. It can be a little more aggressive. But yeah, so what happens if you die in the term? There's two types of taxes. This was in my FAQ. Let's just pull it up. This is the most complex question with a charitable lead trust. What happens if you die within the term? So that's right here, unexpected problems. If you want the full version, page 36 of my journal article, it's got a whole page on this, but it's really not that big of a deal. Number one, the good news, the federal estate tax, that's vested. The moment you put 10 million in that account, you just save $4 million of estate taxes minimum. That's crystal clear. That's out of your state. But on the income tax side of things, there can be a portion of your upfront income tax deduction might be recaptured. Your estate basically might have some income to pick up and pay taxes on. It basically, even the tax code and the IRS regulations can't figure it out. Those they contradict each other. So we rely on the tax code, which trumps the IRS regulations. The tax code is more beneficial, thankfully. The tax code basically says, how much is recapture? Well, you take $10 million, that's your deduction. And let's say you die in 10 years. Say you've had capital gains of $2 million that flowed through on K1s to you, to the decedent. $10 million minus the $2 million they picked up, $8 million. There's $8 million of recapture. So the estate picks up $8 million of ordinary income, pays tax about $3 million of tax. Okay. Now that $25 million still that evaded the 40% estate tax. So you got a $10 million win on the estate tax side. You got $3 million of income tax. Not a bad result. Also, the CLAT starts taking its own, CLAT continues through year 30. It starts taking its own income tax deductions for all of this. So you don't lose those income tax deductions. So bottom line, death within the term, recapture, unless a client is putting a huge amount of their net worth, like I'd say over 20% of their net worth, we don't really worry about it. If you're young, you're healthy, you got other assets outside of this to pay that recapture tax. We got offsets, the estate tax savings, the charitable planning, charitable deductions going forward. It's not something we'll really worry about it. But if they're putting a lot of net worth, then pretty easy. We'll go and hedge. We'll just buy some term life insurance outside of the CLAT. So then we got some money to pay that recapture if they die in the first 10, 20 years. By the end of 15, 20 years, most portfolios have churned enough gain on K1s where recapture is mostly wiped out by then. Okay.
Hey, Jonathan.
Let's get back to the presentation and
Sure.
polling questions and what have you.
Okay.
Yeah, that was great. And with the kind of a little bit of a segue into the insurance conversation, let me get back and share presentation here. Hang on one second. There's one question outstanding. Ryan, do you want to grab that while I'm doing that?
Yeah, it says why does the modeling show 10 million in the CLAT and 6 million in the no CLAT? And that's because the 10 million is you're getting a tax deduction, whereas you're paying income tax of $4 million, and then you've got the net after tax benefit 6 million in the CLAT. Isn't CLAT grantor? I'm not sure of that question. Maybe the person that asked that question, if you could clarify it, does the 10 million include the tax savings? And I think the simple answer to that is yes. But we've got polling number 2 question. Jonathan, don't end the poll, just minimize it, please, so people can continue to answer those polling questions. But I think we've covered that. It is a grantor trust, and there is taxes on the growth of the assets inside of the CLAT. Don't mean to steal our presenters thunder, but that's one of the reasons why we utilize the private placement life insurance, is to potentially shield the growth or gains on an annual basis inside of the CLAT itself.
Yeah, so I first heard about this optimized CLAT. Jonathon presented to a study group that I was a part of a couple of years ago. And of course, you know, the bells started going off in my head immediately, thinking, oh, this is the perfect place to own PPLI. I mean, all the tax deductions of the money going into the CLAT are tremendous. But again, what about all those tax payments that the grantor has to pick up over that 30 years? Wouldn't it be better to not have to have, you know, him or her pay all those ordinary income taxes and long-term capital gains taxes and whatnot for the course of that 20 or 30 years? And so I immediately, you know, reached out to Jonathon and said, hey, have you considered that? And you know, here we are a couple of years later, having kind of worked through the nuance of that, and as he mentioned earlier, the 170 F10 issues, which we'll get into at the end of this. So what I want to do real quick is run through, and if you've been around our firm in the last, you know, 4 or 5 years, you've seen us talk about PPLI a lot because it's become a big part of what we're doing for our ultra affluent clients. So as you see there for the first couple of bullets, obviously it's blocking the income taxes that the grantor would otherwise pay. But the second bullet there is kind of what Jonathon was just referring to as well. And that's that it self-completes upon untimely passing. So if you've got a large life insurance policy inside of the OCLAT and the grantor or the insured dies, there's a large death benefit, tax-free death benefit that's paid into the trust. And now the trust can accelerate those income tax, or sorry, the charitable payments, and then ultimately complete the gift to the charity, and then the assets can transfer to the next generation more quickly, should you want to. You also may not want to do that, right? I mean, again, facts and circumstances can continue to dictate from that point. So the second bullet here really is about the reason why PPLI is so suitable for ownership inside of a CLAT is really because of the mechanics, the characteristics of it, right? It's low cost structure, the investment flexibility where you get to appoint your asset manager or the client's asset manager to run the money, to manage the money on a fully custom basis. That private equity that Jonathon was talking about, the private credit, the various things you can do. Again, you can do all of that inside of PPLI. So you really don't lose any investment flexibility. Now, I will say one of the things that is different about the OCLAT, if we add PPLI to the OCLAT, is that, as most of you know, there's the investor control doctrine, right, where the owner of the policy cannot directly influence or direct the investments inside the policy. And so, you know, Jonathon, correct me if I'm wrong, but if I do an OCLAT with 10 million and I'm the grantor, I can direct every investment inside there carte blanche, right? I mean, I can buy my own hedge fund, for example, if I wanted to, right?
Yeah, inside directly as trustee of the CLAT, which is permitted, yes.
Yeah. So if I add PPLI, I'm going to have to appoint a third party manager to manage that money, and I won't be able to directly control those investments. So there's a little bit of a tweak and a nuance there to be aware of. But again, once you see kind of the results that we're going to show you here in a minute, it's probably worth doing. So I won't belabor this. Again, if you've been around our firm for the last 4 or 5 years, you've probably seen us present on this numerous times. But for those on the call that don't really know what PPLI is, why it's particularly suited for this, like I just mentioned, again, it's an institutionally priced product. It's designed for investment performance, not death benefit. And again, right here, the big bullet point right here is investments managed by your investment advisor. So again, there's no, we're not managing the money. We're not trying to get you to put money with another firm. It's like, hey, there's no change of, investment relationship, if you want to think of it that way. So it's a very flexible product in order to be able to do that. A quick hit real quick on life insurance taxation. Again, as most of you on the call probably know, but again, this is what makes PPLI and life insurance in particular so suitable for this, addition to the OCLAT, is that we get tax deferred growth inside of the policy. We get that tax-free death benefit. And then this is the real key one here, this tax-free access to cash value. What you're going to see in our model is we contribute this $10 million to the optimized CLAT. We then buy this PPLI product and immediately start taking loans and distributions out of the policy to satisfy the charitable obligation. And again, this tax-free access to cash value is really critical to be able to do that. And the cost of the loans inside PPLI are minuscule. They're almost I call them a why bother. I mean, it's 20 basis points, 5 basis points, 35. I mean, it's again, almost completely, cost-free if you want to think of it that way. So again, super beneficial trade of PPLI, again, compared to a retail product. And then this bullet point here, step up in basis equivalence. So one cool thing that you'll get when the assets are transferred in kind at the end of the OCLAT term to your beneficiaries or whoever you elect to receive the funds, the PPLI policy will be transferred in kind. And so you basically get to transfer a tax-free account from the OCLAT to your beneficiaries, who get to then and continue to enjoy tax-free growth, tax-free access to their cash value, and that tax-free death benefit ultimately when the insured ends up passing away. So
yeah, Ben. So I'll just summarize. I mean, the PPLI solves all of the weak points of the OCLAT. The OCLAT's wonderful. You get this upfront deduction, you get the money out at the end without gift or estate taxes. But during that 30-year period, you've got income taxes. So the PPLI wrapper wipes out all of those grantor trust taxes. It also provides death benefit if there's unexpected death in the term and you got a bunch of money coming into the CLAT, pay off that charity early, unlock the CLAT before the 30-year term. And then also on the back end of an OCLAT, those assets come out with no income tax or gift tax, but they do have a carried over lower tax cost basis. So the life insurance also, it causes the assets to essentially come out almost like a Roth IRA on the back end with no tax. So if you think about it, Ben, you and I have talked about this. OCLATs combined with PPLI, it's never taxed dollars because that $10 million goes in, $10 million deduction. From there, it goes in the PPLI, permanently exempt from income tax and federal gift tax, well, permanently, at least into the next generation. So it's a really nice solve.
Yeah, totally agree. And that's actually, it's funny you say that. That's actually our next slide, right? It's like, what's the actual problem we're solving? Again, this is based on the model that we just looked like. That's in the materials that everybody's going to get. That's on the call here this morning. But these are the grantor trust, tax liability. Again, on a projected basis. Again, assuming an 8% rate of return, so on and so forth. But each year, this is that trust tax payment, or excuse me, the grantor tax payment on behalf of the OCLAT. And here's the cumulative effect of that. So fundamentally, what PPLI can block is $28 million or more, right? Depending on the actual performance of those underlying investments, we can permanently block, as Jonathan just mentioned, $28 million of income taxes back to the grantor. And so how does this improve the OCLAT? So what you can see here is the status quo. This is the client, again, who says, I'm not going to do anything, right? I'm going to pay the taxes, Jonathan said. I'm going to invest my $6 million, and I'm going to let it run. Great. So the ending value over the 30 years is $25 million. If I do the OCLAT, just as Jonathan just described, you can see those numbers there. It's the $45 million net to heirs, ending value at the end of the 30 years. And then if I add PPLI and we invest the exact same way as we otherwise would inside the OCLAT, but just through the PPLI structure, we end up with $55 million ending value at the end of the 30 years. You can see right here, this big bump is all that excess death benefit that we're required to buy through the PPLI structure in order to make it comply with the non-MEC rules and things like that. So very powerful. Again, super cool little just bolt on. Like the OCLAT's amazing, as Jonathan just described. But man, if we just add PPLI to the mix, now we're just supercharging the total benefits back to the family group. And you can see here on the net to heirs basis, again, how much better it's going to be all the way around.
I think it's worth noting too that the higher the rate of return, just like Jonathan went through in his infographic, it gets exponentially better for the OCLAT, but then it also becomes exponentially better for the private placement life insurance as well.
That's right. All right, so we're going to go with a polling question 3 here.
Real quick, while we're have the polling question up, we have a question: is the OCLAT GST exempt as well, or only estate tax exempt? And I think we have ETIP issues with an OCLAT, but maybe you can briefly cover that, Jonathan.
Yeah, OCLAT, think of it as it's a non-generation skipping, a lot like a GRAT. You can allocate GST exemption to an OCLAT, but it gets really wonky and complicated. So yeah, you're going to want to apply that GST exemption to other vehicles. like generation skipping, dynasty trusts.
Okay, so we can move on.
And I see we have a couple of false answers on life insurance, which we're going to get into.
Yeah, I think we've got some smarty pants on the call with us today.
Yeah, we're going to talk about that.
Yeah,
there's some risks.
yeah. So there's a couple of more questions that just popped up. Steven's asking, if does the CLAT purchase the policy and pay the premiums? The answer here is yes. There's two ways to get life insurance into an OCLAT or a regular CLAT if you want to do that. One is you can contribute a policy. That is well settled in terms of IRS guidelines and whatnot. I can take an existing policy and contribute that and get the deduction. The other way to do it is to have the OCLAT actually buy the PPLI policy, and we're going to get into that here in a minute. We've got a couple slides on that here in a second.
And then how are these deals structured to allow assets with unrealized capital gains to be contributed to avoid the capital gains? And what is the downside of this strategy is the other question.
So I would say, if you're contributing assets with unrealized gains to the OCLAT, you're not going to be able to avoid those taxes, right? I mean, anytime you sell those positions, that's that pass through back to the grantor. And we cannot fund PPLI with anything but cash premiums. So there's no way to take those unrealized gains in an existing position and get those into PPLI and avoid that altogether. So there's no secret sauce there. We have to use cash to fund PPLI.
I'll touch on that real quick, Ben. Most of those folks are probably thinking about CRTs where, I got some appreciated, Bitcoin or Tesla stock about years ago, put in the CRT, sell inside of the CRT. And a CRT is traditionally thought of as a good vehicle for selling appreciated assets. And it's true, but I've crunched those numbers. I've compared the CRT with a zero basis sold for $10 million asset, $10 million asset with zero basis, compared to selling the asset for 10 million and then putting 10 million into the CLAT, assuming you got other AGI. So apples to apples. The CLAT always, as long as you're going 25 plus years, the CLAT results in about 3 times as much to charity and more economic wealth, like twice as much economic wealth net to heirs. That's without even adding PPLI. So if you forget CRTs, I can never make those pencil out. I actually refused to do them. I used to get referred all the time. I'd run numbers for an hour for free, and people would say, "Thank you very much. I'm not going to do a CRT." So I just don't believe in them. I can't make them pencil out.
Yeah. All right. So this, what we're going to run through real quick next is the analysis. We looked at the improvement that PPLI owned within an OCLAT will deliver to a client. So we're going to run through the analysis here of how we actually got there. So this is that status quo scenario. So again, the client who says, "Hey, I'm just going to stay the course. I'm going to take my $10 million, pay my tax, and then invest my $5.6 or $6 million. By the way, all this is customizable. If you want to see an illustration or an example for your particular situation or a client of yours, we're happy to do that. But here's that money. Here's growing. Here's the charitable payments, as Jonathon showed on his materials. Same thing. We mirror that over here as well. Here's that tax savings that the charitable payment is going to generate back to the client from making these charitable payments right here. Here's the account balance, and here's that net to heirs calculation you see down here. So 25 million, account value $15 million net to heirs. Here's the OCLAT scenario. So here's that $10 million going into the OCLAT. Here's the annual growth. There's that tax problem that we just talked about. Again, you don't have to use PPLI to do that. If you've got some really cool assets that you want to control and you want to invest, that's fine. You just got to be aware of these tax payments that are coming back to the grantor. Here's those charitable payments, again, mirrored the status quo scenario there as well. The account balance that grows over the years. So 45 million on the account balance side, 45 million net to heirs here at the end of the term. And
by the way, these numbers are using a little bit higher benchmark rate, which is why you're not seeing, a little bit more to charity, less on the back end.
That's right. Yeah. These numbers we ran a couple of days ago before we knew that the September number had come down a little bit. Yeah. And rather than rerun buckets of data, we just went with this. And again, the rate may come down again between now and the end of the year, right, Jonathon?
Yep.
And real quick, we had a question around 170 F10, and that is something that we are going to address here in a minute. So please be patient. It's about the CLAT actually making the premium payments, which we'll go through the perceived risks surrounding that, and then our position on that.
Yeah. Yeah. Good point, Ryan. So here's the OCLAT with PPLI. Again, analysis, the calculation, all the numbers. And again, there's a lot on the page, but very simply, what this is showing is the $10 million being contributed to the OCLAT buying PPLI, and then growing it at 8%, right? So here's the cost here in this particular case is not taxes, but it's the cost of the PPLI structure. And we have a full deep dive on expenses and fees and all the stuff that go into PPLI. But you can see here, again, this is way less. The cost of PPLI is way less than the pass-through tax that the grantor would otherwise be picking up on the investment gains inside the account. You can see the annual charitable payment here is coming out of the PPLI policy. So we're actually doing loans against the account value, the cash value of the policy each and every year to satisfy the obligations of the OCLAT back to the charity. And so you can see each and every year these payments go up just like you would see in otherwise, in a regular OCLAT scenario. And then all the way down here, the account balance and net to heirs. Now, if you look at this, you say, well, this is way less than the traditional OCLAT, right? We go back here, 45 million is net to heirs, the account balance of 45 million net to heirs. Here, it's a lot less, and that's true from an OCLAT perspective. What the assets, because of the erosion and that cost, we're internalizing another $4 million of cost in addition to the 34 million that we're giving away inside the OCLAT. But what we also have to account for, though, and that's what this side over here on the right takes into account, is the pickup of not having to pay those taxes over that 30-year time period, right? So this side over here is saying, all right, if we don't have to make those tax payments of $260,000, $280,000, $300,000, and so on and so forth. So over the period of the 30 years, if I get to keep that money in my pocket and I get to grow it at that same 8%, what do I then get to therefore grow that balance to? So what you see down here is the cumulative benefit of adding PPLI is the tax savings invested at 8% plus the net death benefit that the policy actually offers. So I know that's a lot. Ryan, would you add any color to that or add any additional clarifications to that, or Jonathan, either one of you guys?
No, you're essentially eliminating the cost to the grantor of paying that tax as a defective grantor trust. And so instead of having to come out of the pocket to do that, they're able to retain that capital, invest it, presumably at the same rate of return. It does grow to, in terms of that sum amount, it'll grow to 53.5 million. And that's based on the capital markets and income tax assumptions that we have built in there. But that's still subject to estate tax. And that's why there's another $30.7 million, Ben, if you can point to that. Yeah, right. On the taxable account. So we've got a combined benefit of the $25 million death benefit plus the 30.7 million, and that's where we come up with the 55.7 million total net to heirs.
Yeah.
I'll also mention the reason that this is so important, the PPLI wrapper, is if you run the numbers, you really can't have somebody put more than 20% of their net worth or so into the OCLAT, 30-year OCLAT, because eventually the grantor trust taxes get so large. And it's not like a defective grantor trust or something where you can reach in and borrow it or take a SLAT distribution or call up the trust protector to get reimbursed. You cannot, there's no way to reach into the OCLAT and even borrow to pay those taxes. So you have this huge potential grantor trust, phantom income taxes for the next 30 years. Putting 30% of your net worth into it, it might make you go broke. And that's good. We want the inside estate to keep burning down like a defective grantor trust. But the PPLI solves that problem. So really allows us to get more into the OCLAT and supercharge the economic benefits.
Yeah. And then last thing I'll say, and we got to get onto the 170F10 stuff, is these charitable payments that are coming out as loans. The cost of this, because of this particular policy, it's only 20 basis points net cost. So that's, again, why this works. There's no chance of it blowing up due to loan costs or fees or things like that. One more quick data point for you as we get to 170F10 is what if you have somebody who's just not charitably inclined at all? We ran this model just for that data point for you guys all to consider. What's the net to heirs value of someone who says, I would never give the money to charity anyway? Again, doing an OCLAT or an OCLAT with PPLI is still going to be better. even if someone says, I'm never going to give $1 away to charity. So just another cool case study to consider. So 170 F10.
And real quick, we've built a model that allows us to go through each and every scenario, change the assumptions, change the assumed interest rates, change the investment rate of return, and be able to go through each and every what if scenarios so the client can really go into this eyes wide open and understand under different circumstances and different assumptions what it looks like. So the hot topic is 170 F10. So Jonathan.
Yeah. Yeah. So this is so buying life insurance inside of a CLAT. We already talked about very, the solve most people, you can buy a paid up policy, contribute it to the CLAT, you get a deduction equal to cash value of the policy. And as long as the CLAT never pays premiums during that 30-year term, you don't have to run into 170 F10. Now, 170 F10 applies, arguably, if the CLAT has cash and it buys a policy, which is what we're talking about, what we really want to do. And so this has been going on for a long time. I think going back, at the articles that really started coming out were in about 10, 15 years ago in the major journals, when the interest rates got low enough and everybody said, wow, a CLAT with life insurance, that solves everything. And there were some articles by some big names in the major journals of people saying, well, we got this 170 F10 and maybe we should pump the brakes. Maybe you can do it. Maybe you can't buy life insurance instead of a CLAT. But the consequences are too drastic. If 170 F10 applies, the tax consequences, yes, they're terrible. Basically, the whole thing blows up if 170 F10 applies. Okay. So the question is, well, what do you mean it's arguable? Does 170 F10 apply? Well, let's go through that. Okay. First, historically, the IRS, there's no cases, no PLRs, nothing out there on 170 F10 applying to a CLAT. It's just this huge question mark. The IRS has never audited it. It's still hanging out there. But we have the fact that the IRS has never audited or never taken that position. So that's good. What is 170 F10? Okay. Without getting into the tax code and stuff, and I think I will share my screen and show you the analysis, but simply put, there was back in 1999, when this tax code was amended, 170 F10 was put in there, there were these abusive transactions where let's say Ryan is a charity. I say, Ryan, I'm going to donate you $10 million. He says, great. I say, no, but Ryan, I want you then to buy me some life insurance. So I want you to take that $10 million I just donated to you. I'm going to take my tax deduction. And Ryan is then going to go buy a $50 million policy of life insurance for me. And I've got access to the $10 million of cash value inside that policy. So I basically still have my $10 million. I got a tax deduction and I got a bunch of life insurance. And so that the Treasury didn't like that. The IRS didn't like that. And they said, well, that's too cute. That's basically a donation and they're loaning it back to you inside of this tax-free insurance policy. They labeled it charitable split dollar, abusive transaction. And N went 170 F10. And 170 F10, when you read it, it clearly is designed for that transaction because it says, hey, if you donate money to a charity, number one, and then the charity goes and buys life insurance on the donor or their family, then you lose your income tax deduction and some excise taxes, some other things. It's a bad result. The problem with 170 F10 is they throw in this language like they use lots of words like directly or indirectly or any, or these are very broad words in the law, any person. And then so what it does is it takes the charitable split dollar, which you read the legislative history that went in at 170 F10, it clearly said, we want to kill charitable split dollar. The problem is they wrote 170 F10 too broadly, where it seems to capture also inadvertently CLAT transactions. Meaning if I put cash into a CLAT and I buy life insurance, does 170 F10 grab it? And if you read 170 F10, there's a point. Yeah, that's why it's unsettled. It appears to capture CLATs. Now, so that sounds like bad news. But in the law, whenever there's any kind of tax regulation, the first thing you do is you look back at the legislative history. This is all about killing off charitable split dollar. So let's distinguish a CLAT and charitable split dollar, which is why Ryan, is it okay if I share my screen for 5 minutes to show the analysis?
Sure.
Do we have it here? Okay, do we have it here? Okay, let's stick here. I think we've got some regulations on CLE. We got to stick here. Okay.
Yeah.
So 170F10. So here's the distinctions. Good, this is great. Unlike charitable split dollar, number one, the charity never got any cash to buy the life insurance. Remember our charitable split dollar, Ryan's the charity. I'm giving him $10 million and he's then colluding with me to go buy the life insurance policy. In the OCLAT, the charity never got any cash. Okay, there's never any cash that just went directly to charity. It's inside of this charitable trust, but it's not in the hands of the charity. Charity's just waiting for cash down the road. There's no specific charity even. It's a donor advised fund. Number two, the charity never put anything into a policy. Okay, and then number three, there's no participating or colluding between the donor advised fund to buy life insurance on behalf of the CLAT. So the difference is you don't have any participation by a charity putting cash in, and it's crystal clear that a CLAT does not qualify as a quote charity within the 170F definitions, 170C. Another couple policy reasons why I've gotten a lot of comfort around that. I used to be one of those attorneys that just read the Blockmacher article from 2014 and a couple of other ones that just said, hey, 170F10 is a little too scary, so we should all stay away from it. There was this other fellow that just about 5 months after the Blockmacher article in the Estate Planning Journal was written, this other attorney, Jordan X, I forget his last name, he did sort of a counterpoint and said, why is everybody freaking out about 170F10? Here's the point. And if you read those, sit down for a few hours with them, it makes a lot of sense. And so a couple of other policy reasons is, charity benefits from that life insurance. If there's, if the client dies, you've got this huge death benefit that's going to pay into the CLAT and take out and give charity plenty of money. So I think charity's happy with having life insurance in there. They're in first position. They get the first, $3 million or whatever the number is in my $1 million example. And so, so I think at the end of the day, this is a disclosable risk, absolutely, to the client. It's a client's decision point. For me, everything that I know about CLATs, everything I know about 170F10, I would do this in a heartbeat. It doesn't worry me. We've got the fact that the IRS, in the last 25 years of having this in the tax code, has never audited or taken a position that a CLAT is subject to 170F10. But I think it makes a lot of sense. Again, if you really go into the words of that regulation and you read the legislative history, I think they just overly wrote 170F10 too broadly when they say things like indirectly or any person. It starts to grab things that wasn't intended to be in the scope of 170F10. So I think this all got started by a couple of big names writing some big articles saying, hey, has anybody seen this 170F10? Maybe this applies to CLATs. And then everybody kind of just said, we're just not going to touch it. I think if you look into it, this is absolutely defensible. It doesn't give me any pause.
The one thing that came up earlier too, Jonathan, and they say that, the question was, is it safe to assume that the OCLAT is much more beneficial in a low interest rate environment? And I believe the answer is obviously yes. But when we combine the OCLAT with the private placement, then it starts to mitigate some of that rising interest rate risk. And so clearly, yes, it's a better outcome if we've got a lower hurdle rate, right? As opposed to where things are at right now. And we were worried about it going up above 4%. But still, especially, it depends on the arbitrage between the two interest rates. Obviously, if you're invested very conservatively inside the CLAT, then you probably don't want to do that. But you've got assets that are locked up for a long period of time. So you are more likely to be able to take on additional risk that you wouldn't otherwise in a short-term investment strategy.
Yeah, right now the interest rates are perfectly fine. That was great when I had 0.4% at the end of 2020. But even at 4 or 5%, these are historic lows. These are mid 2000 benchmark rates. And rates look like they're going to be coming down with the Fed. So yeah, I don't think you run into I think OCLATs pencil out, especially with PPLI. But once you get to about 7-8% on a benchmark, now yeah, it starts to get, that's a hard hurdle rate. But when you run the model of somebody that was going to give either way, CLAT or no CLAT, even at 8%, they come out ahead with the CLAT. The reason is they get the accelerated deduction. They're not waiting for those charitable payments, and they get the estate tax benefit. So yeah, interest rates right now perfectly fine at 4 or 5%, even 6%. But right now we're going into about 4.5% by the end of the year.
So just to reiterate what we had talked about, we went through an overview of the OCLAT and understanding the tax advantages, and then pairing how we pair the OCLAT with private placement life insurance to really optimize it even further. Take an optimized CLAT and supercharge it with private placement life insurance. But the thing that I just would like everybody to understand, we're always available to brainstorm a fact pattern, and can set up a time to go through and model out a scenario. We've spent a lot of time, effort, and energy creating not only presentation materials to make it easy to understand, but then also a background financial modeling tool. And then Jonathon has loads of information, the article, the frequently asked questions, the infographic, and we'd be happy to we're going to share all of that with you. But I would encourage everybody, if you have a client that has a large income tax liability that's on the horizon and they're looking for ways to mitigate that tax, to contact Jonathon or Ben or myself, and we would be happy to set up a call and really walk through how that could be beneficial for your client. So is there anything else, gentlemen, that you'd like to add? We've got 2 minutes here, and if you have any final questions, please let us know. Well, the one thing I will just reiterate, please complete the survey that's being sent to you. And if you wish to, especially if you wish to receive CE as a requirement, and if you have any questions regarding your CE and getting CE certificates, please feel free to email Kristen with KRISTIN at wealthpoint.net, and she would be happy to work with you to make sure that we get those to you. But please give us, we'll have it to you within 30 days of the completion of this presentation. We will also be sending out the presentation itself, a recording, so you can share it with other colleagues if you choose to do. Along with the other additional documents that Jonathon has that are great educational tools, both for you and for your client. So any closing comments, either of you?
No. I'll say when we post this on the website, one of the things we do too, just so you guys know, is we put like show notes or chapter notes, right? So you can jump right to specific sections, make it easy for you to find the information that you need or want to rewatch or whatever it may be.
Perfect. Thank you again for taking the time out of your busy schedule and attend this quarter's episode of WP90X. And we look forward to having you back toward the end of the year for another exciting topic that we'll be announcing here relatively shortly. So thank you again, and we will see you all in the future.
Thank you.